Welcome back. This is my ninth update on the crisis, and as I said, I keep hoping with each one that'll be the last one. But in this one, I want to take a look at the entire market. And here's why. It's undeniable that US equities in particular have been an upward climb, but it's part of a global equity climb back from the depths of this crisis. And they've been up so much that people are wondering, are they missing the potential for bad things happening? Because after all, we're seeing stocks rising in the midst of really bad news, historically bad news on unemployment, on consumer confidence and consumer spending. And the experts are turning skittish. You know the experts I'm talking about, right? The talking heads on CNBC, the market gurus who are saying, something is wrong here, markets are going up too much, they're overvalued. So what I thought I'd do in this session is first lay out, provide the update on what markets have been doing for the last few weeks since my last one, and then delve into the question of are stocks overvalued, at least US equities. So let's start by surveying the market action. As in prior weeks, I'm going to start by looking at indices around the world. And indices around the world have made quite a comeback in the last few weeks. In fact, I've broken down returns in these indices from February 14th through March 20th, which was pretty much the bottom of this crisis in terms of stock prices, and since March 20th. So if you look across the world between February 14th and March 20th, it was carnage across the world. 25, 30, 35% drop. But if you track stocks all the way through June 1st, you can see that many of these indices have made their way back. Take the S&P 500, down 28% between February 14th and March 20th, up 32% between March 20th and January 1st. In fact, I've heard the last 50 days are the best 50 days that the S&P 500 has ever had. Overall, the index is down, but it's down only 5% since the start of the crisis. Across the world, you see this playing out. And I'll come and take a deeper look at this as we look at the regional breakdown of equities. Now, as stocks collapsed in those first few weeks of the crisis, treasuries benefited. You saw a rush into safety and treasury yields started to drop. T-bill rates, T-bond rates across the board. You can see the drop between February 14th and March 20th. And much of that drop happened before March 15th. What's so special about March 15th? That was the day the Fed officially entered the game. So the rates started dropping well before the Fed entered the game. It was just a flight to safety. But rates now are much lower, and they've stayed low since the crisis started. Now, as people got afraid in those first few weeks, one place it showed up was in default spreads and bonds. As people worried about defaults, you saw default spreads widen across every single ratings class. In fact, BBB rated bonds saw their default spreads almost triple between February 14th and the start of April. But since then, you've started to see a climb down in these spreads as well, just as you've seen in the equity market. If the fear factor is subsiding in equities, it's also subsiding in the corporate bond market. Now, the two commodities I've been tracking through this crisis are oil and copper, both economically sensitive commodities, and copper prices are down about 7% during this crisis, reflecting the reality that global economy is probably going to have a slowdown, at least for this year and the next one. Oil prices are down much more. In fact, in spite of a fairly impressive 4-week climb in oil prices are now down about between 35 and 40%, depending on whether you look at Brent crude or West Texas crude from their February 14th levels. So clearly there's something else going on in the oil market that goes well beyond a global economic slowdown. Finally, looking at gold and Bitcoin. Gold, of course, is a classic crisis asset, and it's played its role at least partially. It's up about 9%. The reason I've paired Bitcoin is at least one of the selling points for cryptocurrencies is they were an alternative asset class. Now, Bitcoin has made a pretty impressive comeback from its lows. It was down more than 50% at the peak of the crisis and towards the end of March. It's now down only 7%. But that said, Bitcoin has behaved more like equities than like a crisis asset during this period. Nothing wrong with that, but if you're investing in cryptocurrencies because you expect it to move in the opposite direction or in a different direction than your stocks, I would think again, because at least in this crisis, that's not the way it's behaved. If you break down equities by region, you still see the differences across regions. Emerging markets like Latin America and Africa have been much more damaged than developed markets. In fact, as you look across markets, you see that US equities are down about 10%, global equities are down about 12%. If you track them all the way through June 1st, but that drop is much lower than it was 6 weeks ago or 8 weeks ago. Finally, I did break down by country, and I know this is not a very informative picture because it just shows you the whole world with different colors. But the green parts of the world are the ones that have been least affected by the crisis, where stocks are down 10% or less. The orange parts of the world are the ones most affected still. So you see, India is more orange, Brazil is really orange. So if you're interested in downloading the entire country breakdown, I'll put the link to this session, and you can download the whole thing and see how individual countries' market caps have done during this crisis. Now, looking across sectors, now you can see why I described this as a pretty orderly crisis in terms of how the market has behaved. If you look across sectors, healthcare, it's almost back to where it was on February 14th. There is almost no effect of the crisis on it. Consumer staples and consumer discretionaries are now single-digit losses. Are there sectors that have been badly affected? Yes. Banks in particular have seen almost 26% of the value wiped out during this crisis, in spite of coming back a little bit during these last 6 weeks. Banks, of course, live in reflected pain and glory. And I think what you're seeing reflected here is the likelihood that this crisis, even if we come out of it, is going to create a lot of defaults. Now, looking at industries, the 10 worst and the 10 best affected industries, this list has remained pretty stable in each of my viral updates. I'm not going to bore you by repeating what you see on them. But the worst affected industries tend to be infrastructure businesses that tend to borrow more. And the best performing industries tend to be healthcare or capital light businesses, technology, online retailing. And many of them have positive returns. In fact, if you had an entire portfolio in capital light technology companies on February 14th, you're probably looking at your portfolio and saying, what crisis? Because you don't see the effect, at least in the numbers. So with that lead in, let's talk about the market. Now, there are two groups of people who are troubled by this market, at least the climb in this market. The first are the people who look at the macroeconomic news coming out and saying, how can this be? How can you have 2 million, 3 million people filing for unemployment claims every week? How can you have consumer confidence collapsing and retail spending falling through the floor and stock prices going up at the same time? I think they're misunderstanding fundamentally what stocks are supposed to do. Stocks are not reflections of what's happening right now. They're supposed to be predictors of the future. But even among those people who get that stocks are supposed to predict the future, there's skepticism. What is this future that stocks are seeing? How come they're not seeing the likelihood that you could have a second shutdown later this year? That many companies are so damaged that they will default and create costs for the rest of the economy. So the second group, I think, is a much tougher group to counter because their argument is markets are predictors, but they're being too optimistic about what they see in the future. Maybe they're in denial. So let's take that first group and let's think about why there's usually a disconnect between stock prices and what's happening in the economy right now. There are three factors. The first is, remember, stocks are not directly tied to macroeconomic indicators, they're tied to earnings. So if you have an economy where the economy is not doing well, but earnings are doing well, stocks can go up. That, in a sense, is what's happened over much of the last decade, where even though the US and the global economy were not doing that well, US stocks continue to do well. The second is, what is the economy that you're tying stocks to? The conventional practice is to tie to the domestic economy. US stocks, the US economy; Chinese stocks, the Chinese economy; Indian stocks, the Indian economy. And if you have a market where your companies are all tied just to the domestic economy, that might work. But in a globalized economy where companies operate globally, maybe the economy that we should be looking at is the global economy. This is especially true in smaller countries and smaller markets where you have a lot of global companies. You should expect to see a disconnect between stocks and the domestic economy. And the third is, as I said, stocks are predictive mechanisms. You wouldn't expect the connection, even if it exists, to be between stock prices today and what the economy is doing today, but stock prices today and what the economy is doing in the future. So here's what I did. I went and downloaded the real GDP growth in percentage terms for the US going back to 1960 and stock returns by quarter. So these are real GDP growth by quarter and stock returns by quarter for the US. Let's start with the obvious. The green line is the real GDP growth up and down. So when it goes below zero is when you have recessions. The red line is stock returns. First, notice stock returns are much more volatile than real GDP growth. Well, that's to be expected, right? Because there are so many other intervening variables. GDP growth into earnings, into cash flows, and each of these is uncertainty. So stocks should be more volatile. And to add on to that, there is noise, created by trading. So then I decided to see whether there was a link between stock returns and real GDP growth. I started by looking at the link between stock returns and real GDP growth in the same quarter, and the correlation was close to zero. There's almost no linkage between what stocks do and what the real GDP growth is in that quarter. Then I said, what if I look at stock returns versus GDP growth in the next quarter? Correlations start to get a little positive. But 2 quarters ahead, a little more positive. In fact, the highest correlation I got was when I went 4 quarters ahead. If markets are predictive mechanism, the correlation backs it up. But even with 4 quarter ahead GDP growth, the correlation is only 28%. So even if you think the market is a predictive mechanism, it's a very noisy predictor. It can be wrong. So then I said, okay, what about whether it's in denial? Is it fully incorporating the bad news that's coming out of this crisis? So to answer this question, I went back to a framework I developed towards the start of this crisis, where I looked at the drivers of value for the index. And these are drivers I've always used. And the drivers are very simply expected earnings and earnings growth in the future, the cash flows you will get from those earnings, and the rate of return you will discount those cash flows back at. So the question, I reframed this framework by bringing in the questions that I would be asking about these numbers. So I said, hey, now that we're in the crisis, one of the first things I have to ask is how will it affect earnings in 2020 and 2021? I think there is no doubt about the fact that 2020 and 2021 earnings will be damaged. How much? Second question, and a kind of add-on question, is how much of that drop will be recouped in the following years? Recouped in what sense? Well, some of those delayed purchases from 2020 and 21 will be made in 2022, 2023, and 2024. How much will be recouped by 2024? Now, out of those earnings come cash flows. So the next set of questions I asked about the cash flows. How much will cash flows be affected in the near term, dividends and buybacks, in 2020 and 2021 as companies get hit by this crisis? And second is, what kind of long-term effect, residual effect will this leave on cash return policy in the future? Maybe companies will be so scared after this crisis they will return less cash going forward. Then on the expected return question, I broke it into 2 parts. What's happening to the risk-free rates, and you can see that already in the table I showed you, the T-bond rate is collapsing. But as in a crisis, the fear factor also rises, which leads people to demand a higher risk premium. How will equity risk premiums change? That is a framework I can use to address the question, what should the market be today? So let's start with some ammunition. Ammunition that I have today that I did not have in March when I first tried this. Then there was nobody trying to forecast the effect because it was too early in the crisis. Now we're starting to see the first estimates pop up on how this crisis will play out in 2020 and 2021 earnings. So you look at the top part of this page, I have 3 groups of forecasts. One by Ed Yardeni, who I respect a great deal. He every week makes forecasts for the S&P 500. And his forecast is that earnings for the S&P 500 in 2020 will be 120, down from 163. That's a pretty hefty drop. That's more than a 25% drop. And earnings in 2021 will bounce back, but only to 150, well below what he was forecasting before the crisis. The consensus estimate for analysts tracking the S&P 500 companies is that earnings in 2020 will be down to, but not as much as their forecast will be down to 126, not 120. So there's a rough similarity. Every single one of these forecasts, they see a drop in earnings in 2020 between 120 and 120, and 130 is I think the bulk of the forecast, and a continued damage into 2021. I also pulled up some forecasts that market strategists are making about 2020 earnings, and you can see the low value that I got from this table is 110. That's a Goldman Sachs forecast for 2020 earnings, and the high value is actually close to 160. The median value that strategists are forecasting for 2020 earnings is about 127.50. Now, looking at cash flows, I have to give you some history. Over the last 20 years, US companies have increasingly shifted to buybacks, and increasing and returned a larger and larger percentage of their earnings as cash flows. So I've tracked first dividends and buybacks every year and then computed two statistics. How much cash is returned as a percentage of earnings and how much cash is returned as a percentage of market cap. If you look at the median values, about 80, US companies, at least the ones in the S&P 500, have been returning about 83% of their earnings in cash flows to their stockholders over the last 20 years. It's a high value of 137%, low value of 58%. In 2019, they were closer to the higher end of the spectrum than the lower end. They were returning about 90%, 89.76% to be precise. They're also returning a pretty hefty percentage of market cap and cash flows. Now the median value is about 4.8%. So file that away because I'm going to use that as my basis for forecasting what's going to happen in 2020 and 2021. Because analysts are predicting drops in dividends and buybacks in 2020. And I'm pretty sure there will be drops in both. The question is how much. Now, speaking of equity risk premiums, I won't bore you with the specifics, but I have been computing implied equity risk premiums by day for the S&P 500 through this crisis. It started the crisis with an implied equity risk premium of about 4.8%. It peaked on around March 23rd at about between 6, 7, 7.5%. And it's been drifting down since. In fact, on June 1st, the implied equity risk premium for the S&P 500 is back down to between 5.3 and 5.5%. So I'm ready to tell my story. And I want to emphasize this is my story. I could be hopelessly wrong. You should develop your own story. And I'll give you the framework where you can convert your story into value. I'm predicting earnings 120 in 2020 and 150 in 2021. In other words, I'm stealing Ed Yardeni's forecast and making them my own. Remember, this puts me at the lower end of the analyst spectrum in terms of predicted earnings in 2020 and 21. I'm also going to predict that 80% of that drop will be recouped, but 20% is permanent. There's going to be some permanent damage left by this crisis on earnings. I'm going to assume a drop of 20% in dividends. That's a pretty hefty drop for dividends, which tend to be sticky in 2020. And that buybacks will be down 50%. Now here the numbers are a little hazier from analysts. They're all saying that they'll drop, but very few are putting numbers on it. But this probably puts me at the heart of where analysts are predicting cash flows will go in 2020. I think that cash flows will remain lower than what they would have been without the crisis for the next 4 years. So I think there's going to be a residual effect on cash flows. The risk-free rate I'm going to leave at 0.66%. I'll come back and address this Fed question, which I'm sure some of you will have. That rate is low. What if it bounces back up? But I'm going to use an equity risk premium of 5.58%. That's the average premium between 2009 and 2019. To give you some perspective, that's much higher than the 4.2% premium that US equities have delivered if you go all the way back to 1960. I think markets have become riskier because they're globalized, they're connected at the hip, and people demand a higher premium. With that story in place, here's my value for the index. So here's how it plays out. My forecasted earnings for 2020 and 2021 show a big drop in earnings, but my cash flow drop on top of it means an even bigger drop in cash flow. So my earnings and cash flows are much lower now than pre-crisis. My required return reflects a much lower risk-free rate, but much higher risk premium, 5.58%. But with my earnings and cash flows and that required return, and incidentally, because I've used a really low risk-free rate, I keep balance by putting the growth rate in perpetuity to that very low number. And I'm going to come back and talk about why this keeps my valuation in balance. Because if I just lower my risk-free rate, it benefits stocks. But if I lower my risk-free rate and lower growth, it's kind of a balanced effect. The value that I get for the index is about 2,926. I don't want to create false precision here. But my valuation with my story is about 2,900 to 2,950, which was about 6% lower than where the index was on June 1st when I valued the index. You're saying, you could be wrong? Of course I could be wrong. In fact, here's what I'm going to do. I'm going to show you how wrong I can be by taking my 5 big assumptions and rather than use the point estimate, use distributions. So for earnings in 2020 and 21, here's what I did. I went back to those analyst estimates, used their median estimate as the center of the distribution, but also built in the likelihood that if I'm wrong, I'm more likely to be wrong on the downside than on the upside. So you notice the distributions have big tails on the downside. Now, I did assume an 80% recovery by 2024. I could be wrong. I could be wrong. It could be 60. It could be 100. No. So I put in a distribution for that. I could be wrong on my risk premium. I've used 5.58%, and there I've built a distribution based on what I've seen over the last 10 years, from a low of 5.02 to a high of 6.12%. Now on the cash flows, where I've used a 20% drop in dividends and a 50% drop in buybacks, it could be a much bigger drop. So again, I've let the tail in the distribution have a much more negative skew to it. I'm much more likely to be surprised on the downside than the upside. And I ran a simulation. In fact, I ran 10,000 simulations, and you see the results in the distribution below. Let me cut to the chase. The median value across the 10,000 simulations was 2,930, very close to my base case. But you can see that the range is significant, but it's not huge. It's much smaller than it was when I valued stocks in March, because then there was much more noise in every one of these numbers. But the bottom line is there's something here for everyone. If you are bearish about stocks, you can point to the median value and say, I told you so. But remember, stocks are overvalued by only 6 or 7%. I mean, don't do anything crazy, even if you believe stocks are overvalued. Of course, if you're more optimistic than me about earnings in 2020 and 21, you're going to find that stocks are undervalued. You could very easily get an index value above 32 or 3,300 with more optimistic projections on earnings in the future. If you're pessimistic about the virus coming back, a second such shutdown, a wave of defaults, then of course your 2020 and 2021 earnings are going to be much lower than my estimates, and your value is going to be much lower. I'm not trying to have it every single way. I'm not, as I said, I'm not a market timer. But it's not my job to go pointing fingers at other people saying, you're wrong, you're wrong, you're wrong. How do I know who's wrong? All I have is my story and my value, and I'll act on my value. But it's not my job to talk you into acting based on my value. Each of us has to make our own judgments. So what I would encourage you to do if you disagree with me is, rather than bitch and moan about it, download the spreadsheet, change the numbers you disagree on. So if you think earnings in 2020 are going to be a lot worse than I predicted, go ahead. Make your estimate, see what it does to value. Now, if you're wondering why I haven't more explicitly talked about the Fed, because some of you I know are Fed obsessed, and you think the whole world revolves around the Fed. This entire market is built on the back of the Fed. And you're probably going to point to my risk-free rate and say, hey, that's what's causing you to come up with the high values, that 0.66% T-bond rate. Well, that's not actually quite true, because my 0.66% T-bond rate, as you saw, also came with a 0.66% growth rate. If you download the spreadsheet, you can play the Fed. You can raise rates to what you think is a reasonable rate. So if you think it's 3%, go in and enter 3% as your risk-free rate going forward. See what happens to value. You're going to be surprised at the muted effect, because when interest rates, you don't change interest rates in isolation. When interest rates change, there is a dynamic effect. It affects my cash flows, it affects my earnings, it affects my growth rates. The effect is much more nuanced than people who get focused just on interest rates think it is. So come up with your own story and your own value, act on that. So in conclusion, here's what I see. Each of us has a narrative for the market, including people like me who claim not to be market timers. Implicitly, we have a narrative about economies and markets. The market has its own narrative. It reflects a collective narrative in pricing of what all investors think. Now, there will be times where your narrative contrasts with that of the market. You're either more optimistic or more pessimistic. Right now, I know many of you have more pessimistic narratives in the market. And when that happens, it's easy to fall into a trap where you think the market is crazy or irrational. The minute you call the markets crazy or irrational, you're saying, I'm right, the rest of the world is wrong, and to view yourself as the last sane person left on the planet. It's my experience that can only get you into trouble. That projecting your feelings, your worries onto the market, and then getting angry that the market is not behaving the way you would, is a recipe for not just frustration, but bad investment decisions. So I'm not saying markets can't be wrong. Of course they can be wrong. But when you question markets, do so with humility and always look for signals, because even a market that is wrong is sending you signals that you should incorporate into your valuations. Right now, we're at a point where markets are sending a very different narrative and sending a very different signal about the future than experts are. And you have a choice. Who do you want to trust? Do you want to trust markets? Or do you want to trust those market gurus that you see on TV or writing in the Wall Street Journal? Given the track record that market gurus have had over the last 20, 30, 40, 50 years, I'll take my chances with the market. Thank you very much for listening in on this session. Have a good day.